You can just fly away when you're feeling low, when you feel you need to get away. You can just fly away. Whoa, say yeah, yeah. So come on, give it up, get into your system and find your happiness. Your life free, you must have it your life, be free. You're on the telephone, telling me that she's gone. Now we've been down this road a million times before. 'Cause it's a sweet sensation, thinking of all that hot temptation. You know it's going right where you want, yeah, you know what's going on. I keep breaking my own rules, playing your love fool, trying to forget about the consequence. Just move with me, move with me, move with me. I want you move with me, move with me, move with me. I keep breaking my own rules, playing your love fool, trying to forget about the consequence. We keep saying we should, and yeah, we know we could stop. But really what it all comes down to is it feels so good, it feels so good when I'm in your arms. Don't you know it feels so good, it feels so good, it feels so good. Don't you know it feels so good, it feels so good when I'm in your arms. Don't you know it feels so good, it feels so good, it feels so good.
It's not any of regrets to me that happened. Things that I planned all this time doesn't come my way. You running away and left me endless room. I'm trying to get up and wake up, but it's not in vain. 'Cause I just want you, baby. Get up.
truth or lie, never feel by while it's inside. a glass of wine to neutralize. Truth and lies.
It's funny how life keeps changing your mind. Opens one door, closes one behind. I will find the child that's lost within me, left behind. The feelings to be set free, twisted love.
speech software on the market. Hey, I'm Joey, and I'm one of the 30 AI voices from Speechless.
Payrolls later this week, all of that good stuff. Throw in China reopening. That's an important data point, and push that through this commodity market. WTI and Brent, I think it was Mr. Hartnett over at Bank of America called this one a sneaky rally, Tom. It continues. WTI up by more than 3%, 118, and let's round it up to 80.
The persistency there is valid, but also I'm going to look at renminbi, John. You had a stronger renminbi all in all, 6.66 yuan. So there is a little bit of movement to watch in EM, and particularly off renminbi about the China reopening.
Bramo, that demand just given this commodity market a bit more of a kick.
Yeah, and frankly, we don't know how long it's going to last or how robust it will be, but it just adds to already this feeling that the only reason why oil prices haven't been even higher is simply because there has been less liquidity in markets, and so people haven't been able to put as much down on options and futures trading, which is really remarkable to me.
Brent crude right now, 123. That's the cross-asset price action. Let's get you some single names, some movers this morning. Let's say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Well, here in the month of May, 7 of the top 10 stocks in the S&P 500 are energy stocks, and that's kind of the story this morning, looking at Brent crude above 124 at one point here on the day, and WTI above 113. ExxonMobil up about 1% on the day. Occidental Petroleum, best performer in the S&P on a year-to-date basis, higher by about 3% here in the pre-market, as a lot of people now start to look at that churn, not only with regards to crude oil, but of course with some of those refined products and the persistent price increases that we're seeing there. And of course, what's good for an Exxon and an Oxy, not necessarily good for the travel space. American Airlines shares down about 1.3% here in the pre-market, as are most of the other airlines, despite an attempt last week to stage a little bit of a rally, a 3-day rally there. We should point out American Airlines going to end the month down here, barring some sort of big reversal here later in the day. You flip it up and take a look at what's going on over in China. You mentioned that, Tom, with the John, with the reopenings there. JD up about 6% here on the day. Alibaba and the rest of the Chinese ADRs also getting a bit of a bid. And keep an eye on some of the U.S. companies that have a big exposure into China, like Tesla and Apple, also getting the bid here as well. Movie theater stocks higher here this morning, with AMC Entertainment up about 7% on the back of that really good showing of the new Tom Cruise reboot of Top Gun. 124 million at the box office just in the U.S. and Canada alone. That was the biggest theatrical release that we've seen so far on a monetary basis since the pandemic. And after the bell tonight, Tom, we're going to get some more earnings, believe it or not. Salesforce coming out after the bell. Those shares slightly higher here in the pre-market.
Romain Bostic, thank you so much. To close this afternoon. Right now, we want to jump to Laura Ram. She's chief U.S. economist at FS Investments. I think we've talked a fair amount about the meeting to be held today. Laura, let me go to the makeup of inflation. What is different about this inflation versus the inflation of previous times?
So this inflation is really coming from everywhere. And I think it is so important to stress the food and energy component of this, because we're used to seeing volatility at the gas pump, but the just really ominous continued climb of food prices has given this combined basket inflation of over 17%. And while the overall inflation, CPI did likely peak in March, but food and energy is still climbing, and it is so punitive. It is punitive. Every household in America needs to buy these two things, and it really is making the Fed look more disconnected. Their focus on core inflation looks like it's way behind the curve.
Right. So, Laura, we showed earlier the famous photograph of Alan Greenspan laying on the floor because of his bad back. So you're in the Oval Office today, and they're doing couch time, Yellen, Powell, the president, and Laura Ram is laying on the floor with her bad back. Laura, what do you tell them about the when of inflation coming down if they just do a prescribed Fed policy?
So, what I would tell them is they need to front load these rate hikes as much as possible, because we know that there's only so much they're going to be able to impact some of the supply chain disruption factors that we've had, energy prices, given that there's such a, again, geopolitical component to that. I would tell them to front load and then take a very data dependent approach come September, come December. The reality is, I don't think they're going to be able to raise as much as markets have priced in.
Laura, why are we not seeing consumers pull back at all? Why are we seeing spending continuing to be so robust, despite some of the sentiment reads that have been negative?
You know, we'll get the other consumer confidence data later today. I do think that you're having this tug and pull between households that are badly concerned about inflation, but are still supported by a healthy job market. That said, the components of spending are clearly shifting. I think we have less spending on durable goods going forward, less spending on non-durable goods. There is going to be a focus on services over the summer. I think it's the back half of the year that gets very uncertain. And that's where I'm concerned that people are going to have their summer vacation. They've been waiting for it. And the kids are clamoring to go to Disney World. But come the fall, with food and energy prices still sticky and high, people really at that point change into savings mode and try to rebuild that savings.
So it has to do with the labor market. We get the latest read on the labor market this Friday. 2021 was notable for revisions, for the upward revisions that changed everybody's view dramatically of a labor market that looked from like it was decelerating to one that seemed like it was red hot all through the summer. What kind of revisions can we expect? What do we see in some of the second and third reads of what we've seen so far this year?
You know, the data collection, I think, is still problematic during COVID. So revisions have been larger. I think it's just important to remember that the employment data are already a lagging indicator of the business cycle. I think we get another strong data, I think we get another strong employment report. It just takes Fed rate hikes quarters to impact the economy. And we often don't see the unemployment rate keeps climbing well after the Fed has stopped raising rates, long after it stopped trying to slow the economy down. So I think we get another strong payroll report. My canary in the coal mine is always initial claims, which have stayed very low. If that starts backing up, we get a 5%, 10% increase in claims. To me, that would be a really hard sign that company behavior around employees has changed radically. But, we have been resilient in this job market, wave after wave of COVID, depending on what's hitting us. Employers are holding on to their bodies.
Laura, I got to go back to first principles. Laura, China reopens. What does the dollar do?
I think the dollar continues to strengthen across the majors, Tom, but I think it can stay strong against the yuan. I think that the exchange rate is going to be one of the last things that the Chinese authorities do to try to right-size the fact that they need to continue to stimulate the economy. I actually think we could see more dollar strength against the Southeast Asian complex and against the renminbi.
Laura, thank you. Laura Rain there of FS Investments on an FX market that I think the next stop for this one, Lisa, away from payrolls from the US data, it's got to be the ECB next week. And President Lagarde, after speaking to Francine Lacqua last week in Davos, really teeing up this ECB to do something it has not done for a long, long time, and that's raise interest rates.
9 days away, I think that this ECB meeting is actually going to be one of the most pivotal in its history, especially in light of record inflation and in light of some of the disagreements that you're hearing from ECB officials, not about whether to raise rates, but by how much and whether a 50 basis point rate hike is on the table.
Have we established whether that is euro negative or euro positive?
No, absolutely not.
Still totally divided on that issue.
Unclear what that actually means at a time when it really has to do with the momentum in the economy just as much as rate positioning. And frankly, the ECB is going to remain behind what the Federal Reserve does. It's just about whether it raises rates to support the economy and create some sort of ceiling for inflation, or whether it actually dampens growth in a material way that's going to be harmful.
And that's a complex one, Tom. With this economic backdrop for this ECB to raise interest rates, what does it mean for this currency? Positive or negative?
I don't have a clue, because you've got to fold in the war. I think the war over the weekend, John, this has been underreported, was absolutely brutal. There were drone images somewhere out in the zeitgeist that looked like something out of World War I. I think the news flow is so extraordinary that Lagarde just has to get to the meeting.
Policymakers in a tough spot around the world, Tom. In about 3 minutes' time, let's call it 5 or 6, Brian Deese, the National Economic Council Director, joining us on this show just 5 minutes away, Tom. Big conversation still ahead.
He's going to talk to lots of the media today, but we need to ask him, John, pointed questions about the history of the Fed sitting in the Oval Office and what the president's going to do about Fed independence. We know for certain President Trump would approach this differently.
A difficult one in many ways, Lisa, and how many times have we said that so far this morning? The optics of this, what do you make of the optics of this meeting later this afternoon between the President, Chair Powell and Secretary Yellen?
how much is this going to be a blame game? I don't think this is going to be kumbaya. This is going to be President Biden saying to the Fed, get on this. This is your job. This is what you need to do to control this. How much does it actually put pressure on Fed Chair Jay Powell to go more aggressively or, frankly, to show his independence? Because right now there's a credibility issue on both sides, getting inflation under control as well as being independent from the political bodies.
Are you suggesting still the Fed pivot wasn't down to the ECI data and it was down to the chairman getting a second term?
I wasn't going there, but I'm sure that you'd like to go there.
I love to go there. I love to go there.
I
Unfortunately,
know.
Chairman Powell won't sit down with me and have that conversation.
I don't
Wouldn't that be nice,
agree
Tom?
with any of that.
Just you don't agree with it? You think it was the
agree.
ECI data point?
I think the Fed is going to do what the Fed does, and the president knows it. This is a president that has a very clear history of LBJ and McChesney Martin, Bill Martin in the middle 1960s. But John, it's okay. Lisa and I didn't agree on Velveeta cheese fondue in Davos either.
I imagine
Nobody
I would take the other side of that one
agrees
too,
with that, Tom.
I'd be firmly on Team Bramo on that issue.
Just a log of Velveeta melting.
Sounds
into it.
disgusting.
Ugh, gorgeous.
Brian Deese is going to be joining us, the National Economic Council Director from the White House, 5 minutes away from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. European Union leaders have agreed to back a partial ban on Russian oil. It would be part of a sixth package of sanctions aimed at punishing Russia for invading Ukraine. The sanctions would ban the purchase of Russian oil and petroleum products delivered by ships, but it temporarily allows EU nations to buy Russian oil delivered by pipeline. That exemption is needed to get Hungary to sign on. Inflation in the Eurozone accelerated to an all-time high this month. Consumer prices rose more than expected, 8.1% from a year ago. Food and energy were the big reasons. The data will intensify the debate at the European Central Bank about how fast to raise interest rates. And President Biden says there are limits to what he can do about guns. Over the weekend, the president visited the Texas elementary school where 19 children and 2 teachers were killed. He has renewed calls for Congress to crack down on the kinds of assault weapons that were used to carry out the killings. PIMCO will be one of the biggest players in this week's drama over whether Russia's credit default swaps will pay out. The firm's largest fund increased its exposure to Russian swaps to more than $1 billion in the run-up to the invasion of Ukraine. PIMCO is part of a panel of dealers and investors that meets today to decide whether the swaps should be triggered. GSK has agreed to buy vaccine maker Affinivax, for as much as $3.3 billion. The British pharmaceutical company is buying up next-generation vaccines while it prepares to split with its consumer health unit. Last month, GSK announced a takeover of Sierra Oncology, a maker of targeted therapies for rare forms of cancer. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think the time has passed for a soft landing. We could have done it, but that would have implied the Fed moving 9 months ago. It should have, it didn't.
That was Mohammed Al-Arian there weighing in on the situation with the Federal Reserve. Chairman Powell a little bit later this afternoon, TK, with the President of the United States and Secretary Yellen as well. An important meeting taking place a little bit later today.
Something we haven't mentioned here, John, the real yield, the 10-year real yield comes down over the last week, 0.12%, showing some of the interesting dynamics within the markets. The dynamic of the morning will be the Oval Office with the chairman of the Federal Reserve System and his president, joined by the Secretary of Treasury, of course, the former chair of the Fed, Janet Yellen. Powell, Yellen, and Biden. Brian Deese joins, director of the National Economic Council, who will be in charge of niceties and pouring tea at the meeting. Brian, the singular distinction here is Yellen codified the word slack of an America unemployed. That is not the case now. Powell's Fed is roughly a fully employed America. How will the president listen to these two about jobs in America in this horrific inflation?
Well, he'll listen to them and he'll underscore his core point, which is that he intends to provide the Fed with the space and the independence that it needs to operate. As you all know, he has nominated a quality slate of people, including at the top of that slate, Chair Powell, to lead the Federal Reserve through this challenging time, and he intends to give them the space to operate. But we are in an environment, a unique environment, and we have unique economic strengths right now, the job market and the labor market being chief among them, but not the only one. Household balance sheets are in a very strong position because over the course of this recovery, Americans have been able to save more and pay down debt. We're seeing business creation, small business creation up at record levels. So we have unique economic strengths, which position us well now to focus on this challenge, which is bringing prices down. Obviously, the Federal Reserve plays a primary role in that, but fiscal policy and the economic choices that we make with Congress play an important role as well. All of that will be on the table today.
Brian, let's talk about that meeting today and whether it's anything more than a photo op, given that you've said You don't want to comment on Fed policy. The Fed doesn't want to comment on fiscal policy. What is the purpose of today? If it's not just a photo op, what do you discuss? What comes out of it? How does it help Americans? And you've seen the polls yourself. 65% of adults say their family's income is falling behind the cost of living. So a lot of people looking at this, it feels just like a photo op. For Americans struggling right now, they want more than just that. Is it more than that?
Absolutely. A couple things. The first is it's standard practice for presidents and chairs of the Federal Reserve to meet from time to time to share views on the economy. In this case, secondly, the president is underscoring something important. The respect for the independence of the Fed as an institution is not something that we can take for granted. It's not something that prior presidents have done to re-underwrite that independence. And so doing so, having the president do so in a public way and underscore that he is committed to making sure that the Federal Reserve as an independent institution can operate is incredibly important at this moment. And it's not just about a photo op, it's about sending that signal clearly to the public. And number three, they have a president, the American people, those who are feeling anxious, and absolutely understand that when people go to the gas pump or to the grocery store, they are feeling anxious. They have a president who is waking up in the morning and focused on how to address that challenge. And one of the things he can do is, in his position, underscore the independence of the Federal Reserve. So I think for all of those reasons, this is an important step in the process, not the only step. And we are going to remain focused. And over the course of the next week and the week after that, we'll focus on the steps that we can take to help try to address price increases as well.
One thing under discussion, and we know this from several reports, and we've talked about this previously, Brian, is student debt relief. The White House considering something up to $10,000. There are people without a college degree wondering why those with a college degree are getting this help. I'll go through the numbers and then I'll ask for your response. So the latest research from Pew points out that 4 in 10 Americans aged 25 or older have a bachelor's degree or higher. Among that, as you know, for Black American adults, for Hispanic adults, that number is much, much lower than 4 in 10. You also know there's a growing earnings gap between those who have a college degree and those who do not. The unemployment rate is lower for those that have a college degree compared to those who do not. So the question, then, Brian, that people are asking if they don't have a college degree right now is, who is that to help? Who are you doing that for? Why are you considering doing that? Who's it for, other than just energizing the base going into the midterms later this year?
Well, first, we should be trying to help everybody who wants to work get into a job that will give them pay and an upward mobility and opportunity to succeed. And one of the things we're seeing about having such a strong labor market recovery right now is we're seeing historic gains, not just overall, the largest decline in the unemployment rate in any recovery in recent history, but also record gains for blacks. Record reduction in the unemployment rate. Hispanics, the largest reduction in the unemployment rate for Hispanics ever on record. So we're seeing that in the job market. We want to do more. A lot of that is about workplace training,
well, Brian, excuse me to jump in. I just want to nail down the point because you know this is important. As you know, and I'll repeat it, those with a college degree seem to be doing much, much better than those without. As you work out relief for the American people at the moment, why is there focus on $10,000 of student debt relief at a time when those people in America who do not have a college degree are getting squeezed by gas prices? Crude again this morning at 118. JP Morgan saying gas could hit $6 later this year. You know the people that's hitting the most. Many of those do not have a college degree. Why is this administration focused on doing something which, let's face it, might play well in the midterms, but ultimately isn't going to help those people that need the help the most right now?
Yeah, my point is we're focused on trying to help everybody. But to the question of those, and a lot of the steps that we are taking are going to help people who have less than a college degree. But when you look at the issue of student debt, there are tens of millions of Americans out there who are in the labor market and now may have gotten some college education or a college education, but are held back by the burden of having to pay, in some cases, extraordinarily high debt. So the question there is are there steps that we can take, prudent steps that we can take to try to help unlock economic opportunities for those families, while at the same time doing everything we can to help create a labor market that is creating dynamics like the one we're seeing now, where for the first time in a very long time, people without a college degree, people with some college degree are seeing economic opportunities to move into jobs with higher wages that they haven't in some time. We're also focused on trying to sustain that and continue that going forward.
Brian, good to catch up. As always fantastic to get your perspective on things. Brian Deese there of the National Economic Council. Tough moment for this White House. Lisa. For many people, they hope that it's more than just a photo op later this afternoon, because the polls for this president aren't promising for this administration.
It's a very difficult issue because there's so many different features that are playing into inflation, and there is such a bifurcated nature to the pain being felt by households that have college degrees and households that have higher incomes and those that do not. How do you sort of parse that out and speak to everyone when everyone's facing a very different reality?
Tom, why the focus on the $10,000? We tried to nail that down. Why the focus on student debt relief?
Oh, I don't. John, to me, it's a side story. To me, the major issue here is investment, spurring investment spending, and spurring trade, as the president did when he went to North Asia. I just think the investment lift is the only way out of this mess.
Futures down about 0.5% on the S&P, on the Nasdaq down by around about 0.1%. A little bit later this afternoon, the President of the United States sitting down with the Chairman of the Federal Reserve. From New York, this is Bloomberg.
En nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor, y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes, como tienen planteados el plan director urbanístico.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
three major areas of the global economy are slowing at the same time.
What the market has told us over the last 3 months really is they think the Fed has got this.
You want to be in this market, but you want to be managing your risks. That's the key here.
It's not just a bond bear market you're talking about, you're talking about a stock bear market.
This is not a time when you try to chase and call a bottom, call a peak, call an inflection point, because honestly, inflection points are happening daily.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. We welcome all of you back to our studios in New York. And John, the singular story this morning is oil, American oil, 119 a barrel. We saw a 122 print on Brent.
Driving season begins, Tom, and it begins with gas prices approaching $5 on average across this country. Some places higher, some places lower. But TK, the direction is pretty clear. We mentioned some of the research from JP Morgan. It could hit 6 later this year. There's a problem, Tom, in the economy for a lot of those people experiencing that in a bigger way. And there's a problem in this White House, too, on how to address it.
This week on economic data gets us to the mid-year outlook. You wonder what the mid-year outlook is, John, for the President of the United States as he sits down with the Secretary of Treasury and the Chairman of the Federal Reserve.
And approaching, Tom, a mid-year outlook for this Federal Reserve as well. Last week it was President Bostic teeing up a pause maybe later this summer. Yesterday afternoon it was Governor Wallace saying, no, thank you. We've got a lot of work to do.
Well, we've got a lot of work to do. John, I'm going to go back to the idea of the many uncertainties that are out there, and downplayed here over the weekend was a China reopening, just the headline that flew by 20 minutes ago of Beijing schools opening in June.
And push that through the commodity market. The trend is clear, Tom.
Yeah.
You were waiting for it. Crude higher, Brent, WTI back through 120 on Brent. Tom, I give the policymakers a lot of grief, but let's face it, if you're a policymaker, if you're a member of a C-suite, a corporation in the leadership, an investor right now, gauging where this economy is and where it's going is tremendously difficult to do because it's moving so quickly.
Lisa, the 8% inflation statistics in Europe today, Italy, Japan, Germany rather, and the rest comes down to the inflation meeting this afternoon, 1 p.m. With the president. What are they going to talk about?
Honestly, and what does it matter? I mean, we were talking about that with Brian Deese, right? I mean, we were asking, what's the point of this meeting if you're trying to reaffirm the independence of the Fed? What are they going for here other than a photo op? Honestly, how do you address it when you keep getting buffeted by new events? And I think about the China reopening that you talk about, Tom.
Well,
how much does this have legs, right? I mean, if they continue to soften a zero COVID stance, how much do we see that sort of upward trajectory go well beyond what people are expecting with oil and gas?
Our guests to a person say the only way to address it, Lisa, is to raise rates. We assume that in June, right?
Look, how is that going to solve the oil and gas problems, right? That's not going to solve the oil and gas problems. Maybe it'll reduce demand, but you're not really seeing that. There still has been an increase year over year in spending, even on an inflation-adjusted basis, even with real wages deeply negative. At what point do you start to see the slowdown in demand and some of the pushback from consumers to the higher prices?
John, I hereby dub June, and I'm going to go back to FDR in the heart of the Depression. As I paraphrase, FDR said, do something. It's do something June.
June 15th, the Fed will do something. Most likely hike rates 50 basis points. They'll go again in late July, Tom. Most likely 50 basis points. And then there's a big gap between then into September with Jackson Hole in between. And that's why there's space, a little bit of vacuum, if you will, Tom, that people are filling with this idea that that's when you get a pause from this Fed into September and beyond.
Brent crude 123.69, West Texas 118.70. What else do you see, John?
Equities down just a little bit, softer by 0.6%. I have to say, if you asked me to guess yesterday after seeing those words from Governor Waller, I'd expect us to be down a whole lot more. We're not. Futures on the Nasdaq down about 0.2%. You are seeing that move in yields, though, up by 8 basis points on a 10-year to 282. Not all of that is Governor Waller, the Fed, and U.S. It's all about Europe, too. Upside surprise, Tom, after upside surprise on inflation reads in Europe. Euro dollar 107.07, negative 0.7 on that currency pair.
Critically, the real yield coming down. It's still positive 0.12%. Something to watch during the week. And someone always watching that is Peter Cherry. He's head of macro strategy at Academy Securities, traveling this nation for Academy Securities, and someone who does a beautiful synthesis across equities, bonds, currencies, and commodities. Peter, what's it like out there? You've been on the plane, you've been in the hotels. I know you stay exclusively at fancy places like the St. Regis, the Four Seasons, and the rest. What are you hearing out there?
Well, none of that's in our budget. But anyways,
I think there's this frustration with where policy is headed. I think, as Lisa said earlier, are we addressing the right thing, right? I think we're supposed to be figuring out how to increase our own ability to supply ourselves, right? How do we turn on, refineries in this country? How do we figure out a solution to this problem that is both holistic and longer lasting, right? So everything seems a little bit haphazard, very reactionary, and we've got to get back to the table and sit there and almost make a war plan. How do we want to address energy problems? How do we want to address food problems? And I think we have to go back to rewarding companies for developing supply chains. And that's got to be the message we should be getting. It's unfortunately not the message we are getting.
Well, Pete, for a long time, you talked about bringing those supply chains home. You were talking about that years ago. Pete, is that a theme that you can invest in still?
Yes, I think so. And I think, in fact, we've been talking a lot about bringing it back to South America, even Mexico. And as we go through these conversations, I think companies are taking a much closer look at proximity when they think about their supply chains. Not only are they looking at cheapness, but they're looking at risk of disruption, cost potentials. And I think everything kind of points you to having those supply chains closer to home. So I think you're going to see, some redundancies built in. I think you're going to see Mexico be a big beneficiary. And that is going on. And I think that's going to be a 3 to 5 year project. I think it's going to be inflationary. It's going to be steadily inflationary, and raising rates does not help that, right? Because it just causes companies to have to spend more to build out those plans.
That's exactly where I was going to go, Peter. A lot of these things are deeply inflationary, whether it's that, whether it's dealing with frankly just the higher costs of employment and being more safe and aware of what's going on. How much is that baked in?
May, we saw the opposite.
So, Leland, give us a sense of what the China Beige Book is charting out to the end of the year. Real GDP of China.
The question is, what are they going to do the second half of the year without rolling back COVID lockdowns or COVID zero lockdowns if they need them, to get the GDP somewhere in a range that they can claim. I think that the new calculus is we're going to get to the fourth quarter. We're going to hope there's no COVID, and we're going to announce 5% GDP for the fourth quarter and try to get it somewhere between 3 and 4% claiming 3 and 4% for the year, then I think markets will say, okay, that's not too bad. We are not on track for anywhere near that. You have to have a lot more support for the economy and a lot less COVID lockdowns for the economy in order for us to get anywhere near that ballpark amount. But I think that's the story they want to tell.
What are we on the ballpark for? What are we on track for based on the China Beige Book data?
Well, I mean, with the second quarter as weak as it is, and if you try to do any type of linear projection, you're under 2. You have to see a lot more support for the economy, which I do think we'll do. As we get close to the Party Congress, we do expect there to be more credit support. We do expect there to be a little more infrastructure. That's not surprising, but you're going to have to see a lot more of that, and it can't be interrupted by lockdowns across the economy.
Leland Miller, Deng. Years ago, to get rich is glorious. How far are we removed from that in this Chinese crisis?
I don't think we're that far away from it. If anything, some of what we've been taught over the past 6 months is that the Chinese model is not actually any more superior than any other model. They just had COVID at a different time, and now they're getting hit pretty hard with it. So everything has to get through the Party Congress. Xi has to have his political moment, and then they can start recalibrating the economy and the stock market and the regulatory system.
Do we underestimate the unchanged China that Deng said to get rich is glorious, and that's what they want to do? And do we overestimate right now the Xi totalitarian shift?
I think we did until a few weeks ago, but I think what seeing all this, headline conflict between Xi Jinping and the ostensible number 2, Li Keqiang, I think people are understanding how much opposition there is within China in the leadership amongst people who are being locked down to this COVID zero lockdown policy and to this slowing economy. And so we are now seeing the dirty side of China's governance right now. And I think people are more aware of it.
Leland, a lot of people have been looking out and wondering what we're going to see with respect to U.S. businesses, multinational businesses, and supply chains, why we haven't seen more of some sort of removal from certain facilities in China elsewhere. Are we now starting to see that after years of speculation?
I think so. And for one reason, the trade war didn't do it. COVID didn't do it. But the lockdowns are something else. And I think you're going to have a very hard time, not just getting Western businesses run across China, but getting expats or anyone to work at these businesses. Nobody wants to be in China right now. No one wants to be locked down and they can't see their families who may be elsewhere for a year, for 6 months, for longer than that. So I think this has shifted the calculus for people who want to live in China. It's made it much more difficult, and they're going to have a much harder time running businesses in China because of it.
U.S. executives are not going to come out and say that they're getting out of China, right? Because they're not going to say that until they already have. They don't want to hamper their employees who work there. They also don't want to get some blowback from the Chinese government. How much have you seen this withdrawal? I mean, this is basically the big question for a lot of companies that have been pretty quiet on this.
Well, I think it's telltale that just about everybody I know is either out on their way out or has already left. And there's very few people with plans to go into China anytime soon. I mean, it's just very difficult to travel, and it's very difficult to operate and live. So people don't want to accept that.
Link that change to the Party Congress then later this autumn.
Well, I think what the Party Congress does is Xi has his moment, and then after that, they can recalibrate certain things. If they need to change COVID zero, they can change COVID zero. If they need to...
But Leland, I don't mean to interrupt, but can they even spare the time to get to December or January of next year?
I don't see how they do it. They have to be extraordinarily lucky, and they have to introduce vaccines. And even by the Chinese reckoning, that they say they're not going to be introducing them until October. So they're having some very, very difficult conversations now. This is far and away the worst conditions that we've seen in years, and there's no way out if COVID returns. So. You have to be crossing your fingers. If you're thinking China is going to really improve in the second half, you are crossing your fingers. Both the policy support will be there, and also that COVID won't just come and knock them off their feet again.
Leland, that's the story of this cycle and the economy. I wanted to finish on something really important. I think, as we've both observed over the last 10 years, it was clear and obvious to a lot of people the trajectory of some of the policy out of Russia and where this might end up. There are some people who have turned around in the last few months and have acted surprised that this has actually happened. Many others aren't surprised at all. Do you foresee the same thing happening further down the road with China? There are allegations of human rights abuses, genocide. Those allegations have come from a range of countries. The US, UK, Canada, and the Netherlands have all accused this country of committing genocide. There was a latest bunch of files last week obtained by a series of media groups, reporters, journalists, Leland, speaking to some of the detail around those human rights abuses. And yet, Leland, it's largely absent from the conversation of corporations engaging with the Chinese Communist Party and the economy there. It kind of sets us up for me, Leland, in a similar story to Russia. They ignore it, they ignore it, they ignore it, and then we get further down the line and they can't ignore it anymore. Where do you see this going?
Well, they're ignoring it in public conversations, but they're talking about it in private. And I think what most of these companies are up to right now is trying to understand whether they're going to have to completely separate their China business, their domestic China business, from their business from the rest of the world. And I think that the more that there is a political imperative to have one set of views on the Western side and find certain things unacceptable, and another view that reflects the Chinese Communist Party's views in the mainland, a lot of these corporations, they may not pull out of China, but what they may do is separate their China business from the rest of the world business. And we're talking about separated supply chains, separated corporate entities. This is a big, big change. Folks don't want to be talking about it, but they're absolutely planning for it right now.
Leland, where would that leave a company like, say, Apple? Where would it leave them?
Well, Apple, I would have to produce what it produces for Chinese consumers inside the country, and then it's going to have to find a lot of extra production capacity in Southeast Asia, in Mexico, and other places to produce all these, iPhones and iMacs and other things for the rest of the world. So what they're not going to be able to do is rely on Chinese production capacity for most of their production going forward. And they're absolutely trying to work out contingency plans, but it's harder for Apple than just about any other country in the world. So they've got enormous headwinds specifically in the next couple of years.
Leland, really interested to get your thoughts on those questions. Thank you, sir. Leland Miller there of the China Beige Book International. Bramo, an important topic that is being discussed, and according to Leland Miller, being discussed a whole lot more behind closed doors.
Yeah, and actions actually being taken. CEOs do not want to come out and say anything with respect to withdrawal from China because they will get blowback. But what they are doing on the ground, according to Leland Miller, is very different. And that has incredible implications, not only for China's GDP, but frankly for inflation at a time when that's going to be inflationary to rebuild supply chains elsewhere.
Futures right now down about 0.75%. There has been a change in the bond market in the last 20 minutes. Not a change of direction, but maybe in a magnitude of the move. Yields are higher by 13 basis points on a 10-year to 286.58. Just a few words from Governor Waller. That's all it took yesterday, Tom, to suggest that he sees a lot more rate hikes in the future to get inflation back down towards 2%.
Now, some legit dollar strength as well. The euro was a 107, now 106.86, and that bears watching. And it's confirmed by Euro Swissy coming in. You really wonder some of the tensions there beneath the headlines.
Looking forward to catching up with Savita Subramaniam of Bank of America a little bit later this morning. We'll catch up with her in about 20 minutes on Bloomberg TV. Alongside her, Peter Cecchini of Exonic and Michael Purvis of Toolback, and on the situation in this equity market and which side to be on right now, with President Bostic or with Governor Waller. The Bank of America view just around the corner from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. European Union leaders have agreed to back a partial ban on Russian oil. It would be part of a sixth package of sanctions aimed at punishing Russia for invading Ukraine. The sanctions would ban the purchase of Russian oil and petroleum products delivered by ships, but it temporarily allows EU nations to buy Russian oil delivered by pipeline. That exemption is needed to get Hungary to sign on. The CEO of Xau's Fund Management says the US is on track for a recession. Dawn Fitzpatrick was interviewed for Bloomberg Wealth with David Rubenstein.
There's a lot of discussion about a looming recession, and the bottom line is a recession is inevitable. It's a matter of when. And when you look at what markets are pricing here, they're pricing it fairly soon. So in the 2023 context, depending on which asset classes you're looking at, I actually think markets might be wrong. And the reason is the consumer right here is in extraordinarily good shape.
Watch David Rubenstein's exclusive interview with Xau's Fund Management CEO and CIO Dawn Fitzpatrick tonight, 9 p.m. New York time on Bloomberg Wealth with David Rubenstein. The town of Uvalde, Texas, has begun saying goodbye to the 19 children and 2 teachers killed in last week's elementary school massacre. Visitations at the town's funeral homes were held yesterday for 2 10-year-old girls. This week alone, 12 funerals are planned. Meanwhile, lawmakers have said they'll consider what can be done to stem gun violence. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Gwalior airport, as you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh there are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We have unique economic strengths right now, the job market and the labor market being chief among them, but not the only one. Household balance sheets are in a very strong position. We're seeing business creation, small business creation up at record levels. So we have unique economic strengths, which position us well now to focus on this challenge, which is bringing prices down.
A spirited conversation with the National Economic Council Director, Brian Deese, who I believe will be serving tea today. For the President, the Secretary of Treasury, and the Chairman of the Federal Reserve System. Look for that coverage on Bloomberg at 1 o'clock on radio and television. Lisa Bramlett and Tom Keene, John Farrow in treatment for his next property right now.
In treatment.
And joining us right now with the clearest note of the morning is Tom Satoris, head of fixed income research at Strategas. It is a Baird company. I love the clarity of your note that Biden, Powell, and Yellen have easy lifting down to a 5% inflation rate, but then. Is that really going to be the topic today on the couches in the Oval Office?
I think so. And the Biden administration has a very real problem here. They've got to get inflation down to a more comfortable 3%. But the problem with that is getting it down to 5% is pretty easy. It's just seasonality, it's base effects.
Right.
Tightening will get us down to about a 4%, but getting down to a 3% probably is going to engineer a recession, and that's the real difficulty that both the Fed and the Biden administration have.
Are the PhDs at the Eccles Building looking at reaction functions and virtually differential calculus of the how to go from 5% to 3% inflation?
I think they are, but the question is, do they over-tighten along the way? If you look at the past history, the PhDs have said, keep going, and eventually something broke before they actually got to their model-driven end game. And there's a very high chance that happens again this time as well. They over-tighten and a recession ensues.
Tom, what kind of recession would it be?
Well, at this point in time, probably a fairly shallow recession because as has been mentioned, I believe Brian Deese had mentioned it earlier in the show, you're looking at a very good cushion right now for the consumer base. Home prices, cash out refis, and very strong wage inflation. So a recession should be shallow at this point unless the Fed really makes a mistake or there's another shock that we're unaware of.
Tom, do you buy this feeling that we heard last week that Raphael Bostic's train of thought was the right one, that there'd be some sort of pause in September or possibly after that when the Fed reassessed and decided to pull back from some of the tightening? Or do you think that the market is underestimating right now the resolve at the Federal Reserve?
Yeah, I think a pause is inevitable, whether it happens in September or later on this year. A pause could very well mean a slowdown to a 25 basis points per meeting rate hike path and really no change to the expected terminal Fed funds rate, and balance sheet reduction continues to proceed. I really don't think we're going to see a pause in the sense that the Fed basically stops tightening.
To fold in your work with Jason Trenick's work at Strategas, does the market do the heavy lifting for the Fed? Does the market get out front on this and create a tightening atmosphere?
Well, the market does, but we estimate the market so far has done the equivalent of about 160 basis points of tightening. So if a neutral Fed funds rate is 3% and inflation is basically running at a sticky state of 4%, there's a more tightening to come from the market. So the market has more tightening to go.
Okay, if a neutral Fed funds rate is 3%, what does that mean for a 10-year?
That means if we're still looking at a 4% sticky inflation, that means a 10-year has to be at or above 3%, but perhaps not by much. We'll say somewhere between a 3.25 to 3.35 is where you'd expect the 10-year to kind of deposit as a terminal rate, and it very well may come down below that fairly quickly once again.
So basically, has the Fed already been priced in? I mean, that's been basically the theme, that the first half of this year has really been about pricing in the rate moves, and the second half of the year will be pricing in the recession that you think is almost inevitable. Is that how you see it?
Yeah, I do think so. The Fed tightening path or rate hike path has been priced in, and that is a market pricing now somewhere around a 3 to 3.25 Fed funds rate. What's probably not priced in is, one, a full recession risk, as evident by an S&P 500 about 4,100. But also, with 10-year yields, even at about a 286 as of this morning, you're still talking about 10-year yields below what the market expects the terminal effective Fed funds rate to be. So the market really isn't pricing in balance sheet reduction risk. And the same is true for mortgage spreads. You just don't see the spreads at levels that would indicate stress there.
Let's go back to your wheelhouse, which is Fannie Mae, and as you just mentioned, mortgage.
Yep.
You're not mere mortal on this. You're actually a god of studying Fannie Mae and housing data. How askew is our housing boom, or is it normal what we've seen?
Well, I think it's normal in the sense that you have a backlog, a queue of housing demand from the last decade that was probably pushed forward by bad policy coming out of 2010. And you also have had an underinvestment in housing. So now we're kind of playing some catch up. You add to that the fact that nominal growth has been pretty high, as well as very low mortgage rates. Even mortgage rates today, 5.25%. It's below nominal growth. So housing demand is strong. It's consistent with where you'd expect it to be. The question is, can home price appreciation continue at this pace? And the answer is almost certainly no.
So the second home that Lisa bought up by Tupper Lake with 800 acres overlooking some portage, and I think it's called Blackfly Camp.
Literally, you have scars from that,
She's
don't
not
you?
going to break even for 15 years? Is that what you're saying?
Well, I'm not going to make an individual base case call, but if I were buying at these prices right now, I'd be looking at demand softening over the next 12 to 24 months and potentially some seasonal weak spots where housing actually turns lower over the next 2 years.
What do you think, Lisa?
I think that you have some real memories about portaging and black flies. That's what I think. Tom Sassouris, thank you so much.
It's the time of year, Tom.
Yes.
Tom, it's black fly season, right, Lisa?
It is. Are we going to keep going with black flies? I am very much looking forward to black flies in our annual family vacation up in the Adirondacks. We'll be enjoying it. It'll be fantastic. Lots of portaging for the kids, Tom.
Not one single chemical has ever worked in the skin against a black fly.
You're not wrong about that.
Thank you so much, Mr. Tegas here. But, Lisa, I bring it up because it's his wheelhouse. It's what he's acclaimed for when, Jason brought him on at Strategas years ago. I'm not hearing enough about the housing outcome in America. I
think it's a good point that you're making right now, that perhaps we're not going to see a blowout of the entire pricing model like we did in 2008 and 2009, but we might see a lost decades of profits. Particularly in certain areas. I don't know the answer to this. It's going to be really curious, especially at 9 a.m. when we get some data.
Lisa, oil, Brent crude popping 124 print moments ago. That's a wow statistic.
That's a wow statistic at a time when a lot of people say there's more to go.
Did we miss Pharaoh? I think we did. I thought, we got through it.
We got through it. We missed him.
We're not on speaking terms, but it worked. Good morning.
Welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. The biggest upset of the men's draw so far on day 9 in Paris. 19-year-old Olga Rune clinched the biggest win of his career as he took out the number 4 seed Stefanos Tsitsipas to reach the quarterfinals. The Dane is making his debut at the clay court slam and was playing in his first 4th round match at the majors. And on the women's side, world number 1 Iga Swiatek notched up her 32nd straight victory as she got past Zhang Wenjun in 3 sets. She'll face Jessica Pegula for a spot in the Final Four after she fought back from a set down against Irina Camelia Begu to reach the Elite 8 for the first time. And don't forget, Tennis Channel's daily live coverage from Roland Garros hits the air at 5 a.m. Eastern. I'm Erin Coscarelli.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
However you get your news.
This is Bloomberg Daybreak Middle East.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Yields up, stocks down. Live from New York City this morning. Good morning, good morning. We're down 0.75% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, looking for signs of a bottom.
We've seen a nice little rally.
Certainly a relief rally of some sorts.
The NASDAQ climbed 1,000 points off the bottom.
What you see is a bear market rally.
Bear market rally.
Setting the stage for a bear market rally. We don't believe that the market bottom is in just yet.
We got several hints along the way.
It's too soon to tell. Looking at a 1 week rally after 7 weeks of pretty significant carnage.
A lot of breadth thrust to the downside.
You have to be careful.
Inflection points are happening daily.
Maybe you get your bear market rally, but the bigger picture here is that valuations are in a long-term kind of re-evaluation.
If companies can keep delivering here, then we will build that bottom and we will start to have a rally.
There's a strong likelihood that even in September, October, we're going to see a repeat of what's happening now in the markets.
The risk is still there.
After a big week of gains, joining us now to discuss is Bank of America's Savita Subramaniam, Peter Cecchini of Exonic Capital. Let's begin with you, Savita, an easy one. What's the difference between a bear market rally and something more substantial?
Well, it's hard to tell at first, but I think that, a bear market rally is just a little bit of a relief rally or a position-driven rally, driven more by kind of selling fatigue than anything else. I mean, I think what's interesting now is that, the question is, where will the market bottom? When will the market bottom? I think the range of outcomes is actually, the floor on the market is actually, not as horrific relative to today's levels as one might imagine. So here we are at around 4,000, and we calculate that a floor on the market is 3,200, even in a recession case. So I think the idea here is pick your spots. Maybe we're not at the absolute bottom, but there are some areas within the equity market that are likely to be, some of the best opportunities, some of the best entry points that we'll see in this sell-off. So that's our view, is sort of focus on the spots within the market rather than just calling where the market bottoms out as a whole.
And just to be clear, Savita, just on the market from the headline number on the S&P, your base case is not a recession, right?
Exactly. Our base case is not a recession. Our base case is that some of this inflation pressure that we're seeing abates. We think that cash on balance sheets is healthy for corporates and consumers. I think the fact that we're getting this question from clients, give me a reason to be bullish, is a bullish sign. I mean, folks are bearish out there, and sentiment indicators have turned to a point where it would indicate that there are more bears than bulls in the market, and that is usually a better sign of a bottom than when there are more bulls than bears.
Peter, if you're struggling for a reason to be bullish, is that reason enough to be bullish?
For me, it's not, and for us at Axonic, it's not. I think the idea right now is that there are a plethora of asset classes in which one can engage outside of equities, where one of our big focuses here is structured products, and protecting your downside in markets like this by investing in cash flowing assets that are somewhat protected from inflation is one of the ways that you can actually express a bullish view outside of equities. This market action right now feels a lot like market action we've seen early on in longer-lived bear markets. I think about late 2000, early 2001, late 2007, early 2008. You have sort of 15 to 20% market sell-offs. People become overly bearish. There wasn't a bear to be found late last year. Now everyone is bearish. That sets us up for a rally. Unfortunately, the boogeyman here remains inflation. And it's pretty much already done its damage. And this idea that the consumer is in fantastic shape, I just think is spurious. When we look at personal savings, it's well down below $1 trillion now from its peak at 6. That was a very important piece of the equity market rally. And the wealth effect has been incredibly important relative to the transmission mechanism for policy in a way probably never in history. So I think the strong consumer recession avoidance argument really doesn't ring true for me.
Savita, what's the counterpoint to that?
Yeah, I mean, it's not just the consumer, it's also the corporate sector. And I would argue that, maybe the consumer is not as strong as they were, right after they got their fiscal stimulus and hadn't spent any money. But today, what we're seeing in our credit card data is that spending is still quite healthy relative to inflationary pressures. We are seeing some pressure in sort of the lower income cohort, but I think overall, what we're seeing is an environment where cash balances are actually higher than they typically are coming out of a recession, which, we had a recession last year, and we actually have seen less leverage taken by corporates and consumers over this cycle. And I think what's also interesting, and this is not necessarily true, a benefit to the market, but it could be a benefit to the U.S. economy, is the idea that companies are actually, kind of in a position where they really need to spend capital, and they have capital. So one of the things that never fails to surprise me is that our CapEx guidance ratio continues to be above trend, despite the fact that companies are guiding lower on earnings expectations, etc. So look, I'm not an uber bull. I think there are lots of problems with this market. We are underweight, high growth tech. I think there are pockets of the market that you still want to avoid. I think we're going through a massive regime change where the pressures are inflation, rising interest rates, energy prices at levels that we haven't seen in quite a while. And these are probably stickier than they have been in prior cycles. But I do think that equities offer inflation protection and cash return, and I think those are the two characteristics where I would agree with my colleague here that cash return or cash allocation and inflation protection are paramount. Where can you get those things? Well, a lot of equities have them: energy, financials, even healthcare staples. These are areas of the market that are less susceptible to the vagaries and the negative impacts of inflation, but can actually benefit from, from a pickup in inflation and are relatively healthy and paying healthy dividends relative to fixed income and other parts of the capital spectrum. Where I wouldn't go is bonds. I still think that bonds are in a bear market.
And you didn't mention tech either, and we'll talk about that in just a moment. Futures negative going into the opening bell, about 23 minutes away. We're down 0.6%. Coming off the back of a monster week of gains on the S&P, up by more than 6 percentage points and snapping the longest losing streak on the S&P going back a decade or so. Let's get to Kaylee Knights for more. Hey, Kaylee.
Yeah, John, snapping that losing streak that actually was the longest since 2001. Following that, though, best week for the S&P 500 since November of 2020. One good week is not enough to undo all of the damage this equity market has seen so far this year, but still this rally was pretty notable. And what else was notable was that it wasn't limited to equities. You really saw gains across all of the major asset classes. Treasuries rallied, price up, yields down for a third straight week. That was the longest since early December. You had investment grade and high yield credit jumping, each having their best week in almost 2 years. In commodities, that Bloomberg Commodity Index is back toward an 8-year high after gains we saw from oil. To focus back on stocks in particular, though, we have to keep in mind the S&P 500 has still seen its worst start to the year since 1970. There has been a lot of bleeding that has actually brought valuations down to their historical average. So maybe now that is creating an entry point for some investors with the urge to buy the dip really kicking back in. But we also have to consider that short sellers may have contributed to the gains we were seeing. Forced to cover some of those wagers, SPY, the S&P 500 Spider ETF, saw its short interest as a percentage of shares outstanding decline for 7 straight days. The real question, though, and Savita mentioned this, is whether or not buyers are going to come back into tech in particular, because that is where so much of the pain and drag has been concentrated. Information technology, consumer discretionary, communications collectively have seen almost $5 trillion in market value wiped out so far this year, and even the remarkable gains for the sector like energy, far and away the best performer in the S&P 500 year to date, only $633 billion. Of course, that sector only has about a 5% weighting in the index overall, John.
Kelly Knights, thank you. Savita asked the question. Here's the question that Savita asked. When is it time to buy tech? It's the question that she's hearing again and again and again from clients. Here's her answer. When clients stop asking this question, their muscle memory of making money on dip buying in tech needs to fade before it bottoms, in our view. Savita, when is it time to buy tech? You say when clients stop asking this question. Can you build on that a little bit more?
Yeah, absolutely. I mean, we kind of saw this in 2000. I remember I was working at a value fund, and there was this, reticence to give up on the tech theme. And I think it's really the idea that you need to wait until the sector is sort of washed out. It's still very crowded. So when you look at positioning within the technology sector, we're still seeing something close to a 30% overweight within the TMT sector. And I think that's got to change before you find a good entry point for technology stocks. This is active long-only managers. So they really haven't given up their bullishness on the tech sector. Remember in the tech bubble, it took about 3 or 4 years for investors to sort of forget about technology, for these companies to consolidate capacity, shore up balance sheets. It was a longer process than a few months. And I think that's what we need to remind ourselves. Value cycles can last for a long time. On average, they last about 6 or 7 years. And we're only in, year 1 or year 1.5, depending on where you started. So I think this is one of those markets where, a lot of investors haven't really seen a market like this. They've only seen tech dominance, and it's going to take a little while to acknowledge and accept the fact that tech doesn't always outperform every other stock in the market.
And Peter, final word here. Are you on the same page?
Yeah, relative to the latter point, absolutely on the same page. I think the one distinction that's important to draw is that I see the consumer credit card data and the consumer credit data overall at 50 billion change on the last print is actually something of a negative, because the savings rate is falling and consumers are being forced to reach into to spend on their credit cards because of inflation is so hot.
Peter Cecchini, Savita, sticking with us. Going into the opening bell about 20 minutes or so away. Futures slightly negative with more. Here's Abby. Hey, Abby.
Hey, John, welcome back. And we are seeing a little bit of a slide here for U.S. futures, a bit of a pause after last week's big rally. And one of the reasons Apple, after the best week of the year, up more than 8% last week, Apple is taking a break, down about 0.5%. Not a big decline, but we do have yields pushing higher, so that could pressure tech in terms of valuation. American Airlines is down 2.4%. This, of course, after oil higher is helping pushing airlines lower. Carnival Corp travel down also as oil is lower. And then finally, Snap lower, John. This, of course, as Vertical has cut these shares to a negative. So the negative spending around ad spending for social media in question, causing Snap to decline.
Abby, thank you. Good to be back with you. We'll get you some morning calls a little bit later in the programme. Coming up, an inflation summit from the Oval Office. President Biden, Chair Powell, Secretary Yellen in the same room this afternoon. That conversation up next.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
We have unique economic strengths right now, the job market and the labor market being chief among them, which position us well now to focus on this challenge, which is bringing prices down. Obviously, the Federal Reserve plays a primary role in that, but fiscal policy and the economic choices that we make with Congress play an important role as well.
The main event today, President Biden, Treasury Secretary Janet Yellen meeting with Fed Chair Jay Powell today to discuss inflation. The White House writing in a statement the following. Yellen will join President Biden and Powell to discuss the state of the American and global economy and the president's top economic priority, addressing inflation. Joining us now from D.C. is Bloomberg's Anne-Marie, alongside Maria Tadeo in Brussels. AMH, straight to you. What can we expect from this beyond just the photo op?
Well, Politico is billing this June for the president as a pivot to the economy. But, Jonathan, as you say, many are just guessing this is going to be a photo op. So maybe it's a performative pivot. What is left for this administration to do when it comes to inflation? You heard from Brian Deese speaking to you, Tom and Lisa earlier. Similar sentiment we heard from the president last night, an opinion piece in the Wall Street Journal, that inflation, this is in the realm of the Fed. It is their priority to deal with price controls, and he respects an independent Fed. So that's really likely kind of the tune and tone of what the start of this meeting is going to be. The press will be allowed in for the top of that meeting. But it does show to the American people that this is what the president says, his top economic or top domestic priority.
Anne-Marie, forgive the snark if it sounds like there is any, but to pivot to the economy, where have they been for the last 6 to 9 months?
Well, I think the economy has obviously always been top of mind, but really it's been framed over the past few months as a lot of the price pressures Americans are feeling is because this war in Ukraine, the Russia's invasion of Ukraine. And the president, in his opinion piece last night, mentioned that, but he said inflation was here and the war has exacerbated it. And that's exactly what we've been talking about. This was always going to be a problem coming into the summer and the fall of this year, but Putin has exacerbated that. And really, Jonathan, you could just feel it today, right? It's the day after Memorial Day, and it is another fresh record for Americans filling up at the pump, $4.62. It's about 50% higher than where prices were last Memorial Day.
$4.62, and it could go higher. Driving season starts. And Maria, in Europe, I believe there is a plan to pursue a ban and not a deal. What have we actually got in Europe?
Yeah, and you know, it's funny because to pick up on what Anne-Marie just said, the line that we hear in the European Union is very similar, that yes, inflation is going up. We see that prices, particularly to consumers, are going through the roof, but they talk about this concept of imported inflation. They say all of this is happening as a result of the war in Ukraine. So it's a very similar line that they take here in Europe too. Now, when you look at what was agreed yesterday, this is a partial oil embargo. Of course, it will affect seaborne imports of Russian Federation oil coming into the European Union. They say just this ban alone will put an end to 2/3 of the purchase that we see of Russian energy, of oil in particular, coming to the European Union. But the other thing that's interesting here is that there is an exemption to pipeline oil. But yesterday we had the Germans saying they want to put an end to this by the end of the year. So if they do what they say out loud publicly that they will do, we could see a reduction of Russian oil into the EU of 90% by the end of the year. What I would note, however, is that after this today, I've spoken to a number of officials, and they all kind of hint when it comes to energy, particularly going back to the inflation story, we've probably reached the limit for the European Union for a while.
Maria, great to catch up. Inflation surprise after inflation surprise, and a wrong kind of upside surprise in Europe right now, that's for sure. AMH down in DC, Maria Tadeo in Brussels, back with us, Savita Peter. Savita, on energy, you say the pain trade in energy is up. Why?
Well, it's interesting. Nobody owns energy. They want to own energy, but it's really hard to hold because of, you know, the emissions and the sort of the negative optics around the sector from just an overall, you know, the idea that oil has a terminal value of 0 over time. First of all, we think that's not necessarily true. We think that investors who are looking for ways to own energy without accessing energy are paying up for energy like industrials or materials or stocks that act like energy but don't have the emissions risk. Second of all, we think that energy companies are actually, they kind of got the ESG memo, and a lot of these companies are on a path towards improving their emissions, as well as, you know, the idea that we need oil to get to net zero. We're not there yet, and we need oil along that path. So I think, you know, what we're seeing is a lot of investors that want to play this oil price, this commodity upcycle, but are still fearful of owning the actual energy companies. We say own energy. It's still super cheap. It's still really underweight in the average long-only fund and the average hedge fund. These are companies that are returning free cash flow that is 9 percentage points above tips, which is another way of getting inflation-protected yield. So we think it's cheap, it's reviled, but it's really the best way to get exposure to the commodity price upcycle.
You can see why they're nervous, though, Savita. We've had a 60% gain on the S&P 500 in energy names, close to 60%. And Peter, for some people, they believe this could be the part of the world, of the market, commodities, energy, that takes down the cycle. And if the cycle rolls over, that's the last place you want to be. That's the view of some people, Pete. Is that the right position to take?
Well, you might have asked me that question because that's my position. As you know, for many months, I've been coming on your show and I've been saying, equities, especially tech, overvalued. In an inflationary environment, get long energy, get long commodities. And I think it's an important bifurcation that's going to begin to occur within the commodity complex, where staying long energy is going to make sense for fairly obvious reasons, the conflict, the war in Ukraine being chief among them. That said, there is now a reflexive impact of inflation on demand, and that's going to start to affect hard commodities like copper, like lumber. We're seeing a reversal in their prices as we speak. And so I think it's going to be, it's going to be very difficult just to say be long commodities, be long energy, be short hard commodities. Soft commodities like wheat, for example, will probably also have a bid given the supply chain disruptions from the war. But again, I think we've moved past that sort of pivot point where hard commodities are now a better sale than buy, in my view.
Savita, I just want to finish on that. The risk around this story, and I guess the counterpoint, the other side of the argument, the other side of the trade, this view that the winners of this inflation story would ultimately be the victim of the rate story, of slower growth. What do you say back to it?
Well, okay. So first of all, I think that the idea that all commodities are created equal is absolutely false, and I agree that hard goods and lumber and metals, where we're seeing actual demand for big ticket items taper off. That's an area you probably don't want to double down on. But I think the idea of oil kind of killing the economic cycle, I mean, certainly we've seen that in the past. We have seen stagflationary environments where, just the spike in oil prices was enough of a draw on consumers' wallets that we actually saw declining oil demand and declining demand for everything else, and that threw us into a recession. So that's obviously what we're watching very carefully. I think what's interesting right now, and the reason that I think that energy has more upside than downside risk, is that China is completely offline. Let's think about when China comes back online and reopens. Yeah. That's going to be even more of an upward pressure on oil prices. So I think, what we want to make sure of is that we don't enter a stagflationary environment. Just in case we do, the best sectors to own, which we're overweight, are energy, consumer staples, and some of the more defensive areas of the market. So I think that's the sort of appropriate positioning as a hedge against that stagflationary environment.
Savita, to your point, just a hint of China coming back online. Crude making new highs again. WTI and Brent. Savita, Peter, great to catch up with both of you. Thank you. Coming up in the morning calls, and later, Michael Purvis at Tallback and expecting the robust volatility to continue. Futures down 0.4%.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Stocks recovering just a little bit going into the opening bout. That's the price action. Here are your morning calls. Truist upgrading Dish Networks to a buy, highlighting the company's discounted pricing and potential partnerships. Morgan Stanley downgrading American Eagle to underweight, expecting the retailer to fall short of lofty second-half targets. And finally, Vertical Group downgrading Snap to negative, pointing to weaker than anticipated ad revenue. Coming up, Torbakin's Michael Purvis expecting monster volatility to continue through the summer. Your opening bout this Tuesday morning is up next.
Gwalior Airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Coming off the back of the biggest weekly gain on the S&P 500, going back to November 2020. Kicking off this week after a long weekend stateside, Wall Street gets back to work with futures negative about 0.4% on the S&P. On the Nasdaq 100, pretty much dead flat on a Russell, a bit softer by 0.4% as well. Let's see opening bout in New York, switch up the board and get to the bond market. Yields drifting higher by about 9 basis points now. Off-session highs at 282.78. And this started by Governor Waller. We'll talk about his words over at the Federal Reserve a little bit later this morning. Over in Europe, upside surprise after upside surprise. It is very much the wrong kind of upside surprise for Europe. Inflation. Bye.